Welcome everyone. Today I want to say a few things about the budget, about budget management, and about the importance of supporting jobs in our community. Now, we're a Labor government, and nothing is more important to us than the jobs and job security of all of those people that we're proud to represent. Earlier today, the Finance Minister released the monthly financial statements for October, and they show tax receipts for the first few months of the year are well below our forecasts. Now, the main reason for this is the very substantial hit to profits that Australian companies have experienced in the early months of this financial year. And this isn't just in resources, it's right across the board. Companies in particular being hit by the high Australian dollar. Now, this has had a greater than expected impact on tax revenue, so that cash receipts to the end of October are $3.9 billion behind our budget estimate. Now, that's a really big hit to revenue. It's a huge whack to revenue. Let's put this into some perspective. In just 4 months, we've already seen the full hit to revenue that we were expecting for the whole year. Now, obviously, dramatically lower tax revenue now makes it unlikely that there will be a surplus in 2012-13. And we ought to be very clear about why this is the case. It's not because the government is spending too much, it's because we didn't collect the amount of taxes that we expected to collect. Spending was actually $1.3 billion lower than forecast so far this year. What we've seen is a sledgehammer hit our revenues. We've seen that from almost the very beginning, from the beginning of the global financial crisis, thanks to the deepest and most sustained period of global economic turmoil since the Great Depression. We're also seeing this hit the revenues of state budgets as well. What we're seeing in our own numbers today means that $160 billion has been ripped from the budget bottom line over 5 years, as that chart over there demonstrates. Now, during this period, we've had a proven track record of managing the budget responsibly and in a balanced way in what have been very challenging global conditions. And we've been making savings in the budget while we have been supporting growth and jobs. The ratio of spending to GDP is 23.8% in 2012-13, which is lower than the average spend under the Howard government. And spending is kept at or below 24% of GDP across the forward estimates. That's the longest sustained run at that level in 30 years. Now, all of this does make our budget one of the strongest in the developed world, and our strategy has allowed the Reserve Bank to repeatedly cut interest rates. And we will continue to exercise spending restraint, even in the face of the global volatility and uncertainty in the global economy. And of course, that volatility and uncertainty in the global economy has been combined with lower commodity prices and a high dollar. That is a very unusual combination of events. And of course, that unusual combination of events has weighed heavily on our revenues, particularly our business tax revenues. I would remind you all that since, I think, mid-2009, we have offset all of our new spending commitments, and that is why revenue to GDP is relatively low. And I want to make this point very strongly today. In our next budget, we will continue with that restraint, and when we're funding new priorities and new Labor reforms, such as the NDIS and the Gonski school reforms, we will do that by changing priorities within the budget. Our spending restraint has been very important in terms of enabling the transition from public to private-led growth, but also in helping the transition from mining to non-mining growth. That has been giving the RBA the scope to cut interest rates. Our economic fundamentals are strong and our economy is resilient, but what we are facing, particularly when it comes to revenues, is a set of unusual circumstances which are all largely driven by global developments. So real GDP remains solid, the unemployment rate is low, inflation remains contained, but growth in nominal GDP has been much softer than many expected. And you'll see this in the next chart. It is nominal GDP which has become much weaker over a relatively short period of time, and now softer than even expected in the September quarter national accounts. Contributing to this has been a persistently high Australian dollar. And we've had a persistently high Australian dollar in the face of a declining terms of trade. That is lower prices for our commodity exports, a very unusual conjunction of events. The terms of trade have come off 14% in the past year alone. Now, to illustrate the impact of these changes, since the 2010 budget, when we first talked about bringing the budget back to surplus in 2012-13, taxes in this year have been written down by $20 billion. $20 billion in this year. And you can see that reflected in that chart. So through this whole period, we have kept making responsible savings to fill what has been an emerging and growing revenue hole. But things are a bit different now, and that's the main point I want to make today. At this stage, I don't think it would be responsible to cut harder or further in 2012-13 to fill a hole in the tax system if that puts jobs or growth at risk. Now, while the real economy does remain resilient, I think it now has reached the point where it would be difficult to responsibly offset dramatic revenue downgrades with substantial short-term savings. And I think that's the bottom line here. It wouldn't be responsible to continue to make up for that revenue hole if that endangered growth or jobs. I simply couldn't stand here and say that that would be the responsible thing to do. It would risk putting up unemployment and further damaging our growth prospects. So I think the responsible thing to do now is to let the automatic stabilisers work, to go to work on the revenue side of our budget. That is the responsible thing to do in these circumstances. Our priority in terms of managing the economy will continue to be to sensibly support jobs for working Australians and growth in our economy. And of course, the type of reckless disregard for sound economic policy we've got from Mr Abbott and Mr Hockey on a daily basis would clearly put all of that at risk. I just want to conclude with a few words because I've been in this job now for just over 5 years. During that period, we've had unprecedented volatility in the global economy. We've had some of the most dramatic events since the Great Depression unfold through the global financial crisis and, of course, leading to a global recession. The aftershocks of those events are still ricocheting around the world and they're still impacting on our economy. Now, there might be a tendency for some to focus, if you like, on the politics of what I'm saying today and not the economics, but I want to make this point very clearly. If the worst thing that people say is we got the economics right again, but fell short on the politics, well, I just say, so be it. Because what I'm indicating to you today is I believe the responsible course of action. At the end of the day, I don't care about the political outcomes, I care about the economic outcomes. And the responsible course of action here in terms of the economic jargon is to let the automatic stabilisers work on the revenue side of the budget. Not to do that would endanger jobs and growth. So the course of action I'm talking about today really comes very much, I guess, to the core of my values and the values of the Labor Party. My priority and the Labor Party's priority is always the jobs of working Australians. The responsible thing to do in these circumstances is to make a thorough assessment of the budget in the new year, methodically working through all of the facts and all of the analysis that is before us, so we can continue to manage the economy responsibly to support employment.